This video explores the full spectrum of recent policy changes under the Trump administration that are reshaping Silicon Valley. From tax relief and deregulation to tariffs, revenue grabs, H-1B visa shocks, and government stakes in chipmakers, these measures are having immediate financial and operational effects while raising long-term strategic questions about innovation, competitiveness, and the U.S.'s position as a global tech leader. Silicon Valley's success has historically relied on three pillars: access to global talent, robust venture capital, and open international markets. Each of the recent policies affects one or more of these pillars. Today, we'll break down how these policies interact, the industry and political reactions, broader economic implications, tech leaders' perspectives, and the uncertain outlook for the Valley. The first and arguably most significant lever shaping Silicon Valley's immediate financial environment is the continuation of a low corporate tax rate under the current administration. For context, U.S. corporate tax rates have been substantially reduced over the past decade, with the Trump-era Tax Cuts and Jobs Act of 2017 setting the statutory federal corporate rate at 21%, down from 35%. These rates have remained stable, providing corporations with a predictable and cash-rich operating environment. Low corporate tax rates translate directly into higher after-tax profits, which in turn affects the strategic options available to firms. In Silicon Valley, this is particularly impactful because the tech ecosystem is heavily capital-intensive, relying on significant investment in research and development, R&D, infrastructure, and human capital. A lower tax burden frees up cash for a variety of uses: accelerated product development, aggressive hiring, equity compensation for employees, acquisitions, and stock buybacks. Each of these can reinforce a company's market position, enhance investor confidence, and sustain innovation momentum. Take the example of a company like Google or Microsoft. With higher after-tax profits, these firms can expand their AI research divisions, cloud computing infrastructure, and global operations without needing to raise additional capital. For startups, low corporate taxes make early-stage investment more attractive to venture capitalists, since potential returns are magnified when the company scales. For publicly traded firms, the combination of low taxes and strong revenue growth can translate into higher earnings per share, which typically boosts stock prices and investor confidence. However, low corporate taxes do more than improve cash flow. They also affect strategic behavior and competitive dynamics in Silicon Valley. Companies may prioritize growth initiatives over cost-cutting, accelerate acquisitions of smaller firms, or expand into adjacent markets. For instance, AI startups might scale faster, invest in specialized hardware, or pursue ambitious multi-year projects that would have been cost-prohibitive under a higher tax regime. The same applies to cloud infrastructure expansion, autonomous vehicle development, and semiconductor design, all sectors where upfront capital expenditures are enormous. Yet, the low corporate tax rate also has broader economic and social implications. While Silicon Valley benefits, there is growing debate about whether low corporate taxes exacerbate income inequality or reduce federal revenue needed for infrastructure, education, and social programs. Critics argue that while big tech thrives, smaller businesses and taxpayers may bear the burden, particularly if federal spending is constrained. In addition, the policy environment can create sectoral imbalances. Highly profitable tech firms enjoy advantages that are not accessible to smaller, capital-constrained companies in traditional industries. Another dimension to consider is international competitiveness. Low U.S. corporate taxes make the U.S. a relatively attractive base for multinationals, encouraging them to repatriate earnings, invest in domestic operations, and retain R&D in the U.S. This strengthens the domestic innovation ecosystem, retaining talent and creating spillover effects that benefit startups and established firms alike. Conversely, Other countries with higher tax rates may see outflows of capital and talent. However, these advantages are not immune to policy volatility. While the statutory rate remains low, changes in enforcement, deductions, or international tax agreements could influence effective tax rates. Silicon Valley leaders must account for regulatory uncertainty, particularly in areas like cross-border profit allocation, stock option taxation, and transfer pricing rules. Uncertainty in these areas can reduce the efficiency gains of low taxes and complicate long-term strategic planning. Importantly, low corporate taxes interact with other policy levers in a complex way. For example, the same administration that maintains low taxes has implemented tariffs on imported semiconductors, raised H-1B visa fees, and asserted government stakes in firms like Intel. While low taxes provide cash flexibility, other constraints increase operational costs and strategic uncertainty. This juxtaposition highlights a central theme. Short-term financial gains from tax policy may be offset by longer-term risks from regulatory, geopolitical, and workforce constraints. From a financial planning perspective, tech firms can leverage low taxes to bolster cash reserves, increase R&D budgets, and support talent retention. Equity-heavy compensation strategies, including stock options and restricted stock units, are more effective when corporate profits are high, allowing startups and established firms to compete for scarce global talent. For public companies, increased earnings can facilitate dividend payments or share repurchases, which in turn can reinforce stock price stability and investor confidence. Finally, low corporate taxes also influence strategic signaling to investors and competitors. Companies can signal market strength and long-term viability by expanding operations, hiring aggressively, and investing in frontier technologies. Competitors may feel pressure to respond similarly, creating a self-reinforcing cycle of innovation and expansion within Silicon Valley. This has both benefits, accelerating technological advancement, and potential risks, such as overextension or exposure to policy shifts in areas like tariffs, intellectual property enforcement, or immigration. The second big change affecting Silicon Valley is that the government is loosening rules for AI and cryptocurrency companies. This means these companies can operate with fewer restrictions, which has both opportunities and risks. What this means for AI companies: they can launch new AI products faster without waiting for long approvals. They have fewer reporting requirements about how their algorithms work or how they use data. They can use international data more easily for training AI models. For cryptocurrency firms, some tokens can launch without SEC approval, making fundraising quicker. Anti-money laundering checks and other financial audits are less strict, speeding up business operations. Companies are encouraged to create self-regulated standards instead of relying entirely on federal oversight. Benefits: faster growth. AI and crypto firms can innovate and release products more quickly. Lower costs. Less compliance means more money can go into research, development, and hiring talent. Attracts investors. Investors like the lower risk of regulation, making funding easier. Global leadership. U.S. companies can move ahead of competitors in AI and blockchain technologies. Risks: ethical issues. Less oversight could mean AI models are biased or unsafe. Market risks. Crypto projects could fail or be exploited, hurting investors. Future regulations. Rules may become stricter later, causing retroactive compliance problems. Big picture relaxed oversight is a short-term win for companies and investors. It encourages innovation and growth, but companies need to act responsibly to avoid ethical problems and prepare for future regulations. Another major factor shaking up Silicon Valley is tariffs and government involvement in the semiconductor industry. These policies directly affect companies like NVIDIA, AMD, and Intel, which rely on global supply chains. Key moves: 100% tariff threats on imported chips. The US government is threatening very high tariffs on some imported semiconductors. This increases costs for chipmakers who rely on foreign suppliers or sell overseas. Revenue sharing. The government is claiming 15% of NVIDIA and AMD's sales in China. Essentially, a portion of revenue from foreign sales now goes to the US government. Export restrictions. Earlier in April, AI chip exports to China were banned, restricting companies' ability to sell abroad. This impacts both revenue and partnerships with Chinese firms. Government investment. The US purchased 10% of Intel, $9 billion stake. Raises concerns about political influence over corporate decisions. Implications for the industry. Higher costs, tariffs make chips more expensive for businesses and consumers. Supply chain disruption, export bans and restrictions, slow production and international sales. Strategic dependence. Firms now need to balance government relations with market opportunities. Investor concern. Revenue sharing and restrictions create uncertainty for stock performance. Broader impact. These moves show a shift from free market operations to government-influenced decisions. Tech companies may change their strategies, moving factories or R&D to other countries, which could reshape the semiconductor industry over the next few years. A key factor affecting Silicon Valley is the sudden shakeup of the H-1B visa program, which brings in highly skilled foreign talent. Key changes. Visa fee increase. Application fee for each H-1B worker jumped to $100,000. This is a huge increase compared to previous costs, making it extremely expensive for companies to hire foreign workers. Targeted impact. Small and mid-sized tech companies are hit the hardest because they rely heavily on affordable global talent. Large tech giants can absorb some costs, but even they face operational challenges. Silicon Valley dependency. Many top tech leaders, including Sundar Pichai, Google, Satya Nadella, Microsoft, Elon Musk, Tesla, and Eric Yuan, Zoom, were once H-1B holders. Restrictive policies now limit the talent pipeline that built these companies. Implications for the industry. Talent shortages. Companies may struggle to fill high-tech roles. Talent flight. Skilled workers may move to Canada, Europe, or Asia, where visa policies are more favorable. Innovation slowdown. Fewer international hires could reduce R&D capacity and competitive edge. Cost pressure. Hiring domestic talent becomes more expensive, affecting profitability. Broader impact. The H-1B shakeup shows how immigration policies directly affect tech innovation. Silicon Valley may need to rethink hiring strategies or even relocate parts of operations abroad to stay competitive. Silicon Valley is reacting strongly to Trump's new policies, particularly the revenue-sharing demands and other controversial moves. Key points. Revenue sharing backlash. The government claims 15% of China's sales revenue from US chipmakers like NVIDIA and AMD. Tech companies see this as extremely high and unfair, almost like government overreach into private business profits. Industry reaction. Major tech associations and trade groups condemn the policy. Terms used in public statements include mob-like tactics and political rent-seeking. Companies warn it could deter innovation and scare investors. Political commentary. Senator Sanders expressed cautious support, framing it as government influence on private companies. Senator Warren criticized it as high-risk cronyism, saying it undermines market fairness. Implications for Silicon Valley investor concerns. Uncertainty may reduce funding for startups. Strategic shifts. Companies may restructure global operations to avoid high fees or tariffs. Innovation risk. Fear of government intervention can slow R&D, especially for AI and chip development. Broader takeaways. Tech leaders argue that these policies weaken U.S. global competitiveness, shows the tension between government oversight and private innovation, which could have long-term consequences for Silicon Valley's growth and talent retention. Trump's recent policies targeting Silicon Valley have highlighted a deep political divide that is creating uncertainty for tech companies across the U.S. On one side, Democrats are highly critical, labeling measures like revenue sharing and tariffs as punitive and politically motivated, particularly against blue state tech hubs such as California. They argue that these actions could weaken innovation and drive talent overseas. On the other side, Republicans defend these moves as necessary to protect U.S. revenue, encourage domestic production, and ensure strategic oversight of key technology sectors. Senators are vocal. Elizabeth Warren has called the revenue-sharing approach and tariffs high-risk cronyism, while Bernie Sanders has expressed partial support for government stakes in companies like Intel, framing it as a measure of strategic control rather than pure profit. This divide leaves the tech industry in a difficult position. Large corporations with political connections may navigate the changes, but startups and mid-sized firms are particularly vulnerable. Many fear being caught in the crossfire of partisan battles, which could affect investment decisions, hiring, and expansion plans. The broader implications are significant. Investor confidence is shaken as the lack of consensus in Washington makes capital deployment riskier. Global talent mobility may shift, with engineers and AI researchers considering moves to Canada, Europe, or Asia, where policies are more stable. Finally, the tech industry now views the federal government less as a partner for innovation and more as a potential source of regulatory and political risk, complicating long-term planning for AI, semiconductors, and other emerging technologies. Trump's policies are not just creating short-term turbulence, they are having a profound impact on America's long-term innovation ecosystem. By imposing high H-1B visa fees, strict export controls on AI chips, and new revenue-sharing requirements, the U.S. is making it harder for top global talent to work here. Silicon Valley, historically a magnet for engineers and researchers from around the world, now faces a brain drain risk. Startups and mid-sized firms, which rely heavily on highly skilled international workers, are particularly vulnerable. Many of these companies have projected growth tied directly to AI, semiconductors, and cloud technologies, and sudden talent shortages can delay R&D and product launches. Even tech giants like Google, Microsoft, and Tesla could see slower innovation cycles if global talent becomes harder to attract or retain. The global competition for AI leadership and semiconductors is intensifying. Countries like Canada, Germany, and Singapore offer more predictable policies, tax incentives, and skilled talent access, making them attractive alternatives for U.S. tech firms. If top minds migrate, the U.S. could lose its edge in cutting-edge technologies, from AI models to autonomous vehicles and quantum computing. Think tanks and industry analysts warn that political instability, combined with inflation and trade restrictions, could make the U.S. less competitive internationally. The cumulative effect is an erosion of the innovation ecosystem that took decades to build, potentially allowing other countries to leapfrog U.S. leadership in strategic tech sectors.